Hello, 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 hello. My name is Randolph Love the Third. I am a wealth strategist. I've been in the insurance and financial services industry for over a decade. I help people have the option of retiring comfortably in 10 to 15 years. And if you're already retired, show you, educate you on how you might be able to reposition your assets to where they're liquid, safe, with predictable rates of return and tax favored. Don't think about what it is, think about what it does. I'm going to be reviewing one of Doug Andrews' videos. Uh, Doug Andrew, he's been in the industry for over 5 decades. That's right, 50 years. So, one of the things that I learned about life, a true principle of life, is you want to seek out people who've already doing what you want to do and ask them questions. Sometimes I would go inside of those groups, those Facebook groups where they have experts, and then somebody would ask the experts. Somebody who just joined this industry would ask the experts what is the answer to X question, right? And the expert's like, you should have spent hours researching it first. You should have spent hours asking Google what to do, or looking at a encyclopedia or something. You should have spent all of that time researching first how to do something before you asked us who already knew how to do it. Uh, I don't think that's the best way to go about it. So one thing that I do in my life is I'm always make sure to go to the experts, people who've already been doing something that I've been doing. I want to ask them. I want to know from them. I want to listen from them. And Doug Andrew is somebody that I listen to. So let's see what is he talking about in this video.
Will help you. The fifth of 5 ways to stack up an extra $1,000,000. In this episode, I'm going to address how to become your own banker to make 100% returns. Get ready. It's going to blow you away.
All right. So one thing that you're gonna see from Doug Andrew videos, is very repetitive, right? He's saying a lot of the same things multiple times, like over and over again. One of the things that Doug Andrew says, one of his favorite sayings is, "What takes the time in learning, not getting it." He wants to make sure you get it, and one way to get it is to show you the pattern. When you're thinking about somebody's IQ, uh, they're not trying to figure out how much pop culture this person knows. They're basically determining how easy it is for this person to recognize patterns. When Doug Andrew is constantly saying the same things over and over again in different ways, he's forcing you to see the pattern and why this works and why it's something worth knowing. Okay, so let's see. Keep it going.
So my name's Doug Andrew, and I've been helping people optimize assets and minimize taxes, prepare for a comfortable retirement so they will not outlive their money now for more than 48 years. But in this episode, get ready, because I'm going to give you a sneak preview right now. I'm going to talk about how to become your own banker and do what banks do to make 100% rates of return up to 500% rates of return. Yep. And then my favorite instrument, which I call the laser fund, and how that can predictably double your money probably every 7.5 years based upon my actual history of using this instrument ever since 1980. And as you do that, I'm going to show you a concept of safe positive leverage, which is the ability to own and control assets with very little or none of your money tied up at risk in that asset. Leverage without liquidity is stupidity, and I'm going to explain that to you. And then by doing this, you'll be able to do what banks do.
Leverage without liquidity is stupidity. Leverage without liquidity is stupidity. That rhymes. The most powerful people in the world have always been the poets, right? And one of the sharks on Shark Tank, I think her name is Barbara. One of the things that she says is there's money in poem and puns. When you can get something that's true and it rhymes, oh man, you in the game now.
Borrow even your own money at a lower rate and continue to earn 100% or more on that money that you borrow, and you use it for your business, but you will accumulate millions, not just 1 million. You do this for 15, 20, 30 years, and you will end up like many of my clients with over 10 million extra dollars by learning how to become your own banker. So let's start with the milk, and then we'll get to the meat. What do banks and credit unions do? What does the multi-trillion-dollar insurance industry do? They're the backbone of America, by the way. If you're not aware, in the Great Depression, there was a lot of real estate that dropped 80% in value. Banks closed, 40% never reopened again. The legal reserve insurance companies in the Great Depression all came through with flying colors. Not one went under in the Great Depression. It's because they have to have reserves on hand that are liquid and safe in case of a run on their institution. And so in 2008, when over 400 banks.
All right. So, and what he's talking about when he's talking about during the Great Depression, none of these insurance institutions went under because of their reserves. So as of today, I don't know if any of you know, but basically banks are only required, your traditional banks are only required to have 10% of the money that they loan out on hand. All right. They only have to, so for every $100 that they give out, they only have to have $10, right? So think about how this works. It's called the velocity of money, right? And the way that the velocity of money works is in most years, banks are able to loan out the same dollar 17 times, 12 times during the bad years, right? During recessions. So you have a bank that's able to loan out the same dollar 17 times, and they only have to have 10% in cash money on reserve of what they loan out. How does the velocity of money works? How are they able to loan out the same dollar 17 times? So let's imagine that you're somebody and you are starting a business, right? You're starting a business. So you go and you rent this space, and you know how it is when you rent a space, you actually have to go and get it built out. So you reach out to these contractors, you might get different quotes, and you don't want a group contractor, but your startup budget might be not be that plush, right? So you want to make sure you get 3 different quotes. And let's say you get 3 different quotes for these contractors, and that one contractor beats them all out. And you get a loan for $100,000 for them to build out this space for you. What is that contractor going to immediately, this general contractor going to immediately do with that $100,000? They're going to go out and buy materials, and then they're going to pay out their subs, and they're going to pay themselves. So this person that they bought materials from with that part of that 100, these different subs doing different jobs that they got for other part of that 100, where are they going to put that money first? In the bank. So that $100,000 just got distributed out to multiple different vendors, different people doing different things, and the first thing that they do is they go and put it straight in the bank, and then the bank is able to then take 90% of that, take 10% and hold it in reserves, and then take that other 90% and loan it out again, and they're able to do that 17 times a year, 12 times a year during recessions. So this is the velocity of money. But what Doug Andrew is saying is the legal reserves, which is what the carriers are using when they're utilizing life insurance in those vehicles in order for infinite banking. What they're doing is they're keeping 50% on reserve. Where the bank is only what is keeping 10%, they're keeping 50%, meaning it's more secure. The last domino to fall if something were to happen in the future. All right, let's keep it going.
Banks in America because of the mortgage meltdown. If you remember this, there were 400 banks in America that went under. 900 more were on the brink. It's called the watch list of going under. The federal government was concerned. Now, a lot of Americans don't realize how close we came to a total financial collapse in 2008. So the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety. Guess where they had it? In insurance companies. And these insurance companies maybe just credited them 4 or 5%. This is in.
And just so you know, what he's talking about, what happened in 2008, the 2008 was the first year of what they call the lost decade, from 2008 to 2018. What typically happens every 10 years, there are 7 good years and 3 bad years in the market. Typically, every 10 years, there's 7 good years, bulls, and 3 bad years, bear. Market. 7 good years, 3 bad years. However, the lost decade, there were only 5 good years and 5 bad years, and those 2 extra years are really significant in causing things to not run as they usually do.
In 2008. So let me tell you what was happening. Banks in 2008 were borrowing OPM, other people's money, meaning when we put money into a bank or a credit union, it's in a lended position. Are they just a benevolent institution paying us interest? No, they're loaning it back. They are investing it. But they said that we put 30 to 40% of it for liquidity and safety into insurance companies. They're bigger, they're stronger. See, some of these insurance companies where I have my money manage trillions of dollars. In fact, one has as much money as the IRS collects in taxes in an entire year. And that's just one insurance company. This is where many governments go to for help when they need it, is to the multi-trillion-dollar insurance industry. So I just bypassed the bank, put my money where the banks put it. But what were the banks doing? They were paying, let's say, 1%. Now, 1%. Every million they borrow at 1% interest, or that they pay 1% interest to us on an annual basis, they're only paying out 10 grand. They turn around and put that million in insurance companies and earn 5. That's what they were doing in 2008. How much more is 5 than 1? Don't say 4. It's 500%. It's 5 times. They were paying 10 grand and they were earning 50,000 on that money. Would you hire an employee for 10 grand that made you an extra 50 grand? Would you buy a widget machine for 10 grand that made you an extra 50?
And this is one of my favorite things of what Doug Andrew does, right? One of my favorite things of what Doug Andrew does is he uses what he calls sticky metaphors, right? And things that you can relate to. So what he's saying is, would you hire somebody for $10,000 if they made you $50,000, right? Would you buy a piece of equipment for $100,000 if it makes you $500,000? All truths are parallel. What he's saying is, what the banks are doing is they're taking money out of your savings accounts and giving you 1%, and they're turning around and loaning it out for at least 5%. They're taking money out of your savings accounts, giving you 1%, and then turning around and loaning it out for at least 5%. And one of my favorite things he says is, what's the difference between 1 and 5? Don't say 4. That's 500%. Imagine if every time you spent out $1, you got back $5. One question I remember in marketing, right? So when you're in a business, something that you always have to do is consider the cost of marketing. something that you always have to do is consider the cost of marketing. And depending on if you're marketing correctly, if you're targeting the right people, if you have a product or service that people want to buy, and you are hitting the right channels to get the right people into your pipeline, to become qualified leads, then prospects, then customers, right? You have to target it the right way. So what I like about what he says is, let me get it. If you have a company that's putting out for one, selling it for 5%, how is that going to benefit you knowing that, right? What he's saying is you can do exactly what the banks do when you are your own banker, right? When you actually are able to leverage the money that you have into your miracle money vehicle, your properly structured index universal life policy. When you're able to leverage that money, when you borrow from your policy, you don't actually borrow your money out of there. You use your money as leverage, and then they get money out of other people's savings accounts. That people in those savings accounts get that 1%. They charge you 5%. And then as soon as they charge you 5% on the other side of their books, they immediately credit you what they just charged you. So it can be a loan. And you want it to be a loan because if it's a loan, it's tax free.
50 grand? You bet. That's called a 500% return on employment cost or equipment cost. Business owners get this. So that's what banks and credit unions do. Now you can become your own banker. So my favorite instrument where I bank my own money is in a max funded indexed universal life insurance contract. And in other episodes on this channel, I talk about how to take the least amount of insurance the IRS will let you get away with.
Now, here's a unique distinction. Notice that he just called it a max funded index universal life policy. A max funded index universal life policy. He didn't just call it a universal life policy. He didn't just call it an index universal life policy. He called it a max funded index universal life policy. The reason why is very important to understand and know these distinctions because it could mean the difference between a lot of money. Now you have such things known as VULs, variable universal life policies. And yes, I am able to sell variable universal life policies. Let me tell you why I don't typically try to sell those things. Not at all. Reason being is when you're dealing with a variable universal life policy, they're actually putting your money directly into the market. What does that mean? That means if your money is directly into the market, that means you do have the potential of earning more than if it was any another type of vehicle. But what it also means is you also have the potential of losing all of your cash value. Because the way a variable universal life policy works is it guarantees you the death benefit, but it does not guarantee you the cash value. That's very important. If you're trying to utilize one of these vehicles in order to have a tax-free liquid retirement, you want to make sure that there's some cash in there. An index universal life policy is using indexing. So it's not actually putting your money in the market. It's just tying it to the market. It's using the indexes as a measuring stick in order to determine how much they should give you. So for example, if point to point, if the indexes have increased, let's say you have a cap of 11% and the indexes increased approximately 15% point to point from when you first connected it from the year prior, and you have a cap at 11%. That means if it hits 15, you get that cap at 11%. If it's structured correctly, if it's max funded and structured properly, your cost of insurance will only be approximately 1%. So that means that year, the indexes did 15, your cap came in at 11, the insurance company took their 1%, and then you got the other 10% completely tax-free. Why is the insurance company okay with taking it completely, taking just 1%? The reason why they're okay with taking just 1%, because all combined, they're dealing with billions of dollars. Just one of these insurance carriers that's been around for 100, 150 plus years in the United States alone. We're not even going to get into Lloyd's of London and all of that. But just one of these carriers that's been around all of that time are managing 3 billion plus in just one building alone. It takes the United States thousands of employees, hundreds of buildings to manage the amount of money that just one of these carriers are managing with just one building of people. So what is 1% of 3 billion plus dollars? That's why they're okay with just taking approximately 1% and giving you the rest tax free. Because remember, because of Internal Revenue Code 7702, 101A, and 72E, as long as it's considered a life insurance policy, it grows tax free. You can utilize it tax free. And when you die, it blossoms and passes to your heirs tax free. What does it mean when it says it blossoms and passes to your heirs? When it says blossoms and passes to your heirs, they have to keep it a life policy. So that means no matter what your cash value in, let's say you put $1 million into this policy, and then over the next 20 years, you borrowed out 2 million plus. And let's say that after you put in just $1 million and you borrowed out $2-3 million from it, and when it's all said and done, you got about $500,000 left of cash value in there. When you die, your family is going to get at least 5% more than that 500,000. Reason being is they have to keep it a life policy. As long as this is considered a life policy, it's going to grow for you tax free. And once again, that's why all of these wealthy families are using it as banks.
And put in the most money the IRS allows, and it turns into a tax-free cash cow, where I have averaged, I earn 11 and I net 10. I've actually earned an average of 9.62% on my, I call them laser funds, ever since I began owning them clear back in 1980. Now, before I go any further, if this is already arousing that curiosity, be sure and post a comment, click like, share it with somebody, but subscribe to this channel. It's
Shameless
free, and I
plug.
post a new educational video almost on a daily basis. So here we go. Let's say that you get it and you begin to sock away money. In other episodes on how to stack up $1 million, I talk about just systematic accumulation. You could sock away $5,000 a month for 120 months, and you'll have $1 million tax-free in the laser fund. Let's say you put in $250,000 and then added a $2,000 a month, and you did that for 10 years. You'll end up with $1 million. You can rent out an apartment on Airbnb for $7,000 a month, which is $350 a night, and your mortgage might be, or your rent might be $2,000. You sock away that $5,000. You're going to end up with $1 million. So let's take that snapshot in time, because I have.
Hold on. So let me explain what he's talking about when it comes with these mortgages. Okay. So let's say that you are in an environment where there's hyperinflation, like the environment that we in now. And currently, let's say you have $500,000 of equity into your primary residence, or one of your investment properties. It doesn't matter. Let's say you have $500,000 in equity, and let's say it's hyperinflation, and out of that 500,000, maybe $200,000 is legitimate. Or let's say, based off the equity in your home, if the market was to crash, you would be underwater. But let's say you have $500,000 in equity, right? Because of this hyperinflation. What a lot of people do is they go and they get the money, the equity out now while they're able to do it, while the economy is somewhat level, why it's somewhat doing good. Because guess what? It's okay to say you got $500,000 in equity into your property, but what happens when you go to try to get a loan and they tell you they can't give it to you, they won't give it to you? What happens if you try to sell your house for what your home was appraised for, but nobody won't buy it? When you need property equity the most, that's when it's the hardest to get. So what people do is when times are good, they go ahead and grab that equity out and they go ahead and put it in a vehicle to where it's growing. So how does that work? So let's say you borrowing money at 5%. You have a mortgage and you paying 5% interest on that mortgage. Whenever you paying money toward a mortgage, you get to write off that interest, right? But let's go ahead and use 6% so I can make the numbers easy. Let's say you paying 6% on the mortgage, right? Whenever you paying money toward a mortgage, you're able to write off that interest. So, and let's say you're in a 33% tax bracket. If you're writing off the interest and you're in a 33% tax bracket, that means really and truly you're only paying 4%. You're only paying 4% toward mortgage. So let's say that money that you took out, that you're paying this mortgage toward, you put into a properly structured, max funded index universal life policy that's earning 7 to 10% tax free. You just took out a loan, a 6% loan. And because you pay a majority of that loan is going to interest in the beginning years, because of that loan is going toward interest, you're able to write off 6% on your taxes. So when you write, and if you're in a 33% tax bracket, when you write off 6%, that means really and truly you're only paying 4% toward that mortgage. But that money you borrowed out is earning at least 7 to 10% tax free in an index universal life policy. All right. It's called arbitrage. All right, let's keep it going.
Many clients that I've mentored that end up with at least $1 million or more. So far, so good. So let's take that snapshot in time. You now have 1 million in your laser fund, your max funded IUL. Now, here's what savvy, smart business owners do. They operate as their own bank.
In this video, I'm going to show you how it's possible to get a $100,000 funded stock trading account where you take none of the losses and don't have to risk it.
Now listen very close. Stay with me here. You have $1 million and now you see an opportunity. Now, I have many clients that invest in real estate. So I'm going to use an example of one of my clients that his specialty is to find multi-unit apartment complexes that the seller just wants out. They're tired of being a landlord, fixing toilets, evicting tenants, and so forth. And they don't want to even fix up the property. They just want to liquidate it. So he finds those properties and he buys them and he fixes them up and then he turns around and flips them. He doesn't like to be a landlord himself either. So just like somebody that buys and flips houses by fixing them up, he buys big apartment complexes and fixes them up and then flips them because he has a pool of investors that want to buy apartment complexes that are fixed up and have good cash flow. So far, so good.
It's levels to this, man. How many people, whether you believe you will or believe you won't, you probably right. That's what Henry Ford says. How many people aspire to flip houses? Have you ever aspired to flip apartment buildings? It's all about perspective.
He comes across one and it could be, golly, 10 million, 15, 20 million. Many times he needs an earnest money. So he will call me up and he'll say, Doug, I need $1 million to tie up this piece of property. Send me over that form. Now it's one page. I email it to him. And he has his laser fund, his IUL policy. And he puts his name and his policy number, which is like an account number. And then it says, would you like to withdraw $1 million out of your policy or would you like to borrow? What do you think he does? Yeah, he's smart. He borrows. See, if he withdrew the $1 million, now he doesn't have the $1 million in his policy earning interest. That's okay. You can do that. He doesn't have to pay tax when he withdraws.
One of the things that I like that Doug says, he says there are 3 ways to get money out of your life policy. There's only 3 ways to get money out of your life policy. The sad way, the dumb way, and the smart way. The sad way is you die. It's a good return on your investment, right? But it's very sad to get your money out of your life policy by dying. The dumb way is to withdraw money. The reason why that's the dumb way is because if you withdraw money from a life policy, not only you just permanently decreased the available money that you can put in there, but now you've also created a taxable event. Once you withdraw money from a policy, then it's a taxable event and you will be taxed on it. The smart way is to borrow money from a life policy. Why is that the smart way? The reason why it's the smart way is because as long as it's borrowed money, then you're not going to be taxed. There are only 3 spots to put money on in your internal revenue return. There's earned income, passive income, and portfolio income. Nowhere on there does it say borrowed income.
Draws it, but he is a business owner. He's savvy. So he borrows. And people go, why would he borrow his own money? There's 2 ways he can borrow. The first way is called a zero wash or zero cost loan. He can tell the insurance company, you know, I think we're headed for a recession. So I will borrow $1 million. And in order for it to be tax-free, the insurance company has to charge him at least a nominal interest rate. So that might be 2%. So the insurance company is charging him 2% a year, which is 20 grand, but he doesn't have to write out a check for 20,000. That loan is not due and payable during his lifetime because the insurance company is crediting on that collateral, that $1 million in the policy, the same 2%. So he borrows it to, they credit to, it's a zero wash loan. It doesn't cost him anything to call it a loan. And that's what qualifies the $1 million to be tax-free. But he's savvy. Usually he will use the index loan like I do. Now, what's an index loan? By the way, if this is going, wow, be sure and subscribe to this channel. This is just the tip of the iceberg, folks. So he goes for the index loan, which means, okay, you can charge me 4% or 5% on my $1 million. Why would you want to pay 4 or 5% to borrow $1 million out of your policy when you could?
Look at Doug Andrews' exaggerated mannerisms. Why? Right? Pay attention to how he puts emphasis on these things, and his face, it just deadpan. He just delivers all of that. The same mannerisms of a just exaggerated mannerisms of like I can't even think of who, you know, like a Steve Martin or something like that.
Just be charged too, because the $1 million that is still in your policy because you didn't withdraw it. Yeah, it's just semantics. You're borrowing by having your $1 million as collateral. And now you're saying, okay, you can charge me 5%. He did this in 2017. He borrowed $1 million out and they charged him 5%. What's 5% on $1 million? That's 50 grand. He didn't have to write out a check for 50 grand because they credited him the indexed rate that year on the $1 million that he left in the policy. Guess what he earned in 2017? He capped out on his universal life at 25%. 25% on $1 million was 250 grand. Are you with me? They deducted 50,000 out of the 250,000 he earned. He netted $200,000 of growth on the $1 million in his policy, tax-free. He netted 20% return tax-free on his policy while he was using the $1 million to acquire an apartment complex that he fixed up and he sold and he made $2 or $3 million.
Did that go over your heads? Did that go over your heads what he just said? All right, so one of his clients had $1 million inside a properly structured max funded index universal life policy. So what he did was he borrowed from the policy, but he did what they call an alternate loan. What that means is when you borrow from the policy, they're going to charge you 5%. But right after they charge you 5%, they're going to immediately credit you 5%, and you can use that 5% to buy upside options. So 5% of $1 million is $50,000. They charged him $50,000 to borrow out $1 million from his properly structured max funded index universal life policy. That year, the market gained 25%. So that means the $1 million was in an index that's uncapped. So you have indexes that are capped, some indexes that are uncapped, right? So That million earned $250,000 that year because he borrowed it out, that alternate loan. Boom. I'm borrowing it out, and I want you to use this interest to get upside options. And because you're using this interest to get upside options, we're going to be able to make money off of this $1 million while we're using it in the real world. We're using $1 million. I call them twin babies. When you can look at your money on the screen, but also have the cash, tangible cash in your hand, like twin babies, right? And who doesn't love twin babies, right? So what happened was he borrowed out $1 million. He's using it to flip these apartment buildings. He's then that's that $1 million that he's using in the real world to flip apartment buildings earns 25% inside of the properly structured index universal life policy. When you subtract the 50,000 that he was charged in interest, and so 25, just so you know, 25% of $1 million is $250,000. So that $1 million, while he's using it in the real world with the tangible paper ones and hundreds, right, and 20s and 50s, he has also money inside the digital world that just earned 25%, $250,000. When you subtract the $50,000 that he was charged in interest in order to borrow that money against the money that it earned, because it was an alternate loan of $250,000, he just made a net gain of $200,000 tax-free, on top of whatever he's going to make from flipping that property. Amazing.
Is this blowing you
away?
away?
Tell me that ain't amazing.
This is how many savvy people accumulate millions of extra dollars by accumulating in a laser fund tax-free and then becoming their own banker and borrowing money. I don't care if you borrow money at 5 and you earn 10. How much more is 10 than 5? 100%. Would you hire an employee for 50 grand that made you an extra 100 grand? I do that all day long. That's actually been the average, is earning 100% more than the cost of borrowing out of a max funded IUL. Some years you may not. Other years you may make 25%. As of the recording of this episode, last year in 2021, we had clients on their Index Universal Life lock-in gains of 61.33%. Yep. So let me just give you one other little aha here. Let's say you borrowed $1 million out of an IUL policy at 5%, and you could earn 10%. But what do you do with $1 million? Let's say you go out and buy 5 rental properties, and you only pay 20% down on each of those. So the rental properties now are being rented out for double what the interest payment is being charged. So you got this positive cash flow, and you're getting some tax breaks because you're able to do that. Or maybe you went to a mortgage company and borrowed it. You can leverage safely, but maintain liquidity by putting it into the IUL. So you can take that and pay it back into the IUL policy, and you can actually end up putting money back into where over just a period of 10 years or so, you can end up with an extra $5.75 million by borrowing on your IUL, leveraging safely on property, and then taking the cash flow, putting it back into the IUL, and you're still earning money on the original balance that was in there because you leveraged on your IUL. If your brain is going, whoa, you need to read my book. So here's how you can claim your free copy. This is book number 11.
Hey, so he's talking about his book, The Laser Fund. Is basically a properly structured index universal life policy. That's what I call a miracle money vehicle. Don't think about what it is, think about what it does. So I'm glad y'all took the time to watch this video with me. That was Doug Andrew doing his thing, been in this game for over 50 years. I am a part of one of his, not one of, he only has one master's group. It's not a lot of people, but maybe a couple handful of people. And I'm one of them. And once again, one of the principles of life, whatever you want to do, figure out exactly what you want to do, and then look for people who are doing it. And you ask them how to get where they, what did they do to get where they at now? All right. Make sure you what I gotta tell you, you gotta hit the like, you gotta hit the share, you gotta hit the subscribe. I am Randolph Love III. I'm a wealth strategist. I help business owners, high income professionals, and current retirees. I educate on how to mitigate taxes, have your money be liquid, safe, with predictable rates of return, and tax favored. Check in for more in the future.